If you look at financial press headlines, you will see references to outlook, the outlook being changed, the outlook being issued. What is that all about? In this Footnote Friday episode, I will dive into managerial guidance, who issues it, what items are being forecasted, and some of the trends that we've seen over the past several decades. Here we are in the landing page of the Wall Street Journal business section. If I'm going to scroll down to the section that's titled earnings, we can see a lot of the recent news about the companies disclosing their earnings. This section is going to get a lot more activity in July because for all of the firms that are on the fiscal December year end, June 30th is the end of the quarter. So in July, we're going to have a lot of firms disclosing their earnings. But even now, we certainly see activity here because not everybody is actually on a December fiscal year end. So we have some companies that finished their quarter in April, in May. So now we're seeing their disclosures. If we look at the language, they talk about what happened to them in the quarter, surprise profit, but they also talk about the future. This Cracker Barrel lifts the outlook for the year, as opposed to Smucker expects sales to fall this year. Vail cuts the outlook again. What is this outlook that these companies are talking about? They're talking about management guidance. So management guidance is voluntary and forward-looking disclosure to communicate expectations of future performance. Not every company is issuing management guidance, but quite a lot are. And when they do, there is a lot of focus in terms of the news that they're actually giving us. Possible guidance items include revenue. That's a common one. What do we expect our sales to be? Earnings, both in terms of the dollar amount as well as the per share amount, profit margins, capital expenditures. That's a pretty popular one as well in terms of what the company is actually spending to build out their asset base. And then there could be a variety of them. A lot of them are industry specific. A lot of them are non-GAAP numbers. So key performance indicators, it could be things like booking or web traffic. In terms of the format, the guidance is going to differ. A lot of times it is quantitative guidance. So they are literally giving the numbers. Sometimes we call this a point estimate when they're going to say, here's a specific number. Earnings per share are going to be $3. That's what we expect for the year. A lot of times it is a range. Earnings per share are expected to be between 290 and 310, for example. Sometimes this is qualitative guidance, things like mid-single digit revenue growth. A lot of times it's even going to be softer than that. It's going to be something just about the trajectories of the future. In terms of the types of guidance, we have initial guidance. So we didn't know what to expect for next year. And now the company is telling us what to expect. Sometimes it's confirming guidance. Or from now on, they will say, yes, that still hasn't changed. That's our expectation. We have no updates for you. Sometimes there is an adjustment. So we already had a guidance. Now they're saying down a little bit. And sometimes there is a withdrawing of the guidance. And I'm going to show you an example where they said, we know we issued this guidance, but right now there is uncertainty such that we no longer stand by it and we don't want to issue a new one. So we're just withdrawing guidance altogether. We don't see that as much, but that does happen occasionally. In terms of when companies actually issue the guidance, probably the most common place is during the earnings season. So during their earnings press release, they will include a discussion of the expectation of the future. Sometimes the guidance is not in the actual press release, but it is in the discussion in the conference call. Sometimes guidance is outside of that earnings window. It's issued in the middle of the quarter. Typically, that's going to be the adjusting guidance. So the firm will say, I know we issued that guidance as of the last quarter end, but there's significant events here. We want to make sure to update you. So those would be mid-quarter. Those would be filed in other Form 8K filings. Form 8K are material event forms. So they're very short. They're just highlighting one specific event that the company is making aware to their stakeholders. The other venue, which is somewhat common, is when there are presentations at Investor Day. So, for example, an investment bank will have a biotech day and lots of biotech firms are participating. There could be guidance that's released in those venues as well. Let's go back to the Wall Street Journal. Let's take a look at one of these articles. So, J.M. Smucker expects sales to fall this year. So they have also guided for adjusted earnings of $9.75 to $10.25 a share, compared with analyst views of $9.81. So these are, of course, sell-side analysts. It's interesting that the headline of this article and the discussion here is all forward looking. It's all about guidance, even though this information was actually revealed as part of their earnings announcement, as part of their historical look back, the results of the fourth fiscal quarter. If we go to the Smucker SEC Edgar page, let's see if we can find it. In this case, we're not interested in the 10Q and 10K, which is normally when we focus on in our videos, but I'm going to go to the 8Ks. And right here we see 8K, and here they give us this little bit of a hint that this is the earnings release. If we go to the press release, we see that this is their results for the fourth fiscal quarter. They announce their fiscal year results and provide full year fiscal 2027 outlook, some quantitative information here, as well as some qualitative discussion. One more example actually here, so also fairly recent. Lululemon cuts outlook as headwinds mount. So again, they cut the outlook, and this was part of their earnings announcement. Let's find it in the same fashion if we go to 8Ks. Most recent one, current report. I am going to go to the filings, and in the press release, the focus is first on the historical information, net revenue, comparable sales, gross profit, the balance sheet. If we go forward, we see a discussion here of 2026 outlook, and specifically there is the second quarter of 2026 outlook and the net revenue discussion here. This is a range, 2.45 billion to 2.475 billion, and that is a decline of 3 to 2%. Both of these firms released their outlook, one annual, one quarterly, as part of their earnings press release disclosure. Okay, so now I have talked about where to find the guidance. I talked about what is the guidance, point range, etc., what items, but I haven't really talked about why is there guidance? What is the management trying to accomplish and what are the potential costs of that? The number one benefit of the guidance is that it satisfies the investor demand for information. Future is uncertain, and trying to predict where the firm is going is exceedingly difficult if you're outside of the firm. So any information that you can get from insiders of the firm reduces that information asymmetry and allows for the stakeholders to have greater information set. This is going to help the management shape the market expectations, especially if they feel that the market expectations, either based on sell-side analysts or based on just the whisper numbers that they're hearing, are wrong. It's better to essentially avoid surprises and to make sure that everyone has as good of an understanding as possible in terms of what the future is going to bring. One of the main goals here is to avoid volatility. So nobody likes big surprises, even big positive surprises. It's better to have a good understanding. It allows us to work our models. It allows us to have predictability of the future. Giving clear signals in terms of, to the best of your knowledge, where the company is heading reduces that volatility. It's not only demanded by the investors, it's also demanded by the analyst. It helps reduce analyst errors. It helps reduce analyst dispersion, improves the forecasting ability of these parties. Overall, this allows the management team to build credibility in terms of giving clear, consistent, useful disclosure to the market, especially if the track record proves that this is accurate, that they are timely in terms of shaping these expectations, that they are on track in terms of having good internal information, that they have an understanding where their company is going. One of the potential arguments is that it reduces litigation risk because as soon as the management becomes aware of negative information, it allows them to release it to the market, manage market expectations, reduce unexpected swings, kind of preempt bad news surprises. It also allows the management team to shape the narrative in terms of what are the items we want everybody to be focused on. It could be revenues, it could be your growth, your capex, it could be certain non-GAAP metrics, but what do you think are the metrics that are indicative of how your firm is doing relative to competitors, what could be expected in the future? So guidance is a tool in terms of shaping that narrative. There's definitely criticism to be had about the practice of managerial guidance. Probably the biggest one is that it forces in its nature the short-term focus. So the idea that we are so zeroed in on the quarterly performance and even on the annual performance, if we think about long-term projects, if we think about things that the company is doing where the payoff to those things is not going to be seen for years in the future, we want them to engage in long-term value creation, but forcing this practice of managerial guidance on them or expecting it forces them to also really be zeroed in on much shorter targets. There's some degree of a commitment problem, meaning that once you start giving guidance, there is an expectation that you're going to give guidance. Or once you start giving, for example, a quantitative guidance, there's going to be that expectation. Yes, you can change it, but a lot of times changing it will be a signal of its own. Or if you do give guidance in one quarter and then you don't give it, even if you don't mean for it to be a signal, it would be inferred as a signal. There are personal reputational risks for the management team if the guidance is not accurate. That raises questions about how well do you understand your company, or maybe you had better information. Why didn't you incorporate it into the guidance? There are potentially proprietary concerns. Keep in mind that this information is public, so your competitors are also going to see the expectations. They might change their strategies accordance to what they see that you're disclosing about your growth, expansion, etc. Related to the short term, again, once you put this number out there, there's definitely known to be pressure inside the organization that we better meet this number now. Lastly, I had an asterisk on the prior slide where one of the claims was guidance potentially lowers the litigation risk. The opposite side of that is guidance might actually increase the litigation risk because this is yet additional disclosure which is done, which could cause people to rely upon it to make their decisions. It's important to note that there is legal safe harbor protection when the language is very clear that this is a forward-looking statement, etc. There's kind of proper cautionary wording there. However, even with that, there's definitely situations where guidance has been used in litigation, and if there are any concerns that guidance was not done in the best of faith, or that guidance was issued and then management received information that the guidance is no longer valid, but they didn't follow up with a disclosure to update it, potentially it's actually not clear whether the practice of issuing guidance lowers or does not change or even increases the litigation risk. Here's an example of a specific firm. I wanted to look at Microsoft. This is not soft guidance. This is only the guidance that was coded in the database that I have access to, which captures essentially all managerial quantitative guidance. In the early years of the 21st century, they're issuing earnings per share guidance, both on annual and quarterly basis. They're also issuing GAAP earnings numbers. It's important to note here that this earnings per share doesn't actually directly relate to the earnings on the income statement. These are typically adjusted for items that need to be stripped out, like transitory items. The management is forecasting earnings with the understanding that if something happens like a restructuring, that's not going to be included in this earnings per share number. But they also do forecast here the GAAP number, so generally accepted accounting principles, so the full income statement number, annual and quarterly basis. The revenues, so the sales here are forecasted. The CapEx, so capital investments are forecasted. Operating profit and gross margin is forecasted in 1 year. And what we see is that, again, they were heavily forecasting their sales and earnings numbers in the earlier years. And then in 2009, they hit some volatility. They had to pull back some forecasts. And after that, they actually stopped forecasting the earnings and the sales, the income statement number. They do continue to forecast their spending, their capital expenditures forecasted. Up until 2014, when we have a change in management, we don't actually see any forecast from them after 2014, up until 2025, when we do see the CapEx as well. So this is an example of a firm that clearly changed their practice. So they were giving a lot of information, granular information to the market, and then what they were zeroing in on one specific metric that they thought was important. And then they went silent, they went dark. And again, that doesn't mean that they didn't give qualitative information, but they didn't have the same degree of specific quantitative guiding. Here I looked at all firms traded on the US major exchanges. First of all, the sample of firms is fairly stable over this period. This is 2005 to 2025. The number of firms, the dashed line here, it's a little bit higher in the earlier years. We have some firms that exit the market, go private, go bankrupt, and not as many firms entering the market in the middle period. There's a little bit of a spike here, but this spike is not actually super interesting. Most of this are not active, mature firms. This is for the most part driven by the specs that are entering in 2021 and 2022. Let's take a look at the guidance. So you'll notice that the number of the guidance items that are issued per year is actually bigger than the number of firms. But that's because, like I mentioned, for some firms, they will issue multiple times per year. They will give their guidance number maybe in the first quarter for the year, but then they will continuously update it in the second and third quarter. So it is normal that we have a larger number of guidance years. I only focused on the annual guidance, and what we see is that the trends are changing a little bit. The earnings per share was the most common item that was being guided, and then it kind of the red bars, it goes down over time. The sales number was also very popular. It remains one of the more popular ones. That's the light blue. What we have here as the dark blue, these are the capex numbers. It became quite popular in the middle. It still continues to be fairly popular as well here. Gap number is a little bit more popular in the earlier years. We don't see it as much here, so we're really focused on the earnings, which are adjusted for transitory items. And last one, the green one, is earnings before interest, taxes, depreciation, and amortization. These are the green bars. We see them growing in importance and becoming on par with the earnings per share and with the capex numbers. These were the most common items that are being forecasted. There is actually a bigger set, and the scale here is very different. These are seen much less frequently. The gross margin we do see kind of fluctuate a little bit, but quite a few firms do forecast it. As well as the green bars here are the net income. So this is not the GAAP net income. This is the net income that's adjusted for transitory, but it's not on a per share basis. It's on a dollar basis. So that's the difference with EPS. Dividends per share were much more common about 10 years ago. We don't see that many forecasts. And that's in part because buybacks have been growing in popularity and dividends have been falling relative to those. Very light blue, we see some operating profit that used to be popular, but now EBITDA has kind of taken the place of that. We see some pre-tax profit, ROA, ROE, but those are really quite small. So even though we have some firms that forecast them, but not a whole lot. The last thing I wanted to share here is an example of a guidance being withdrawn. So this is just about a year ago, July of 2025, Centene Corporation withdrew 2025 guidance. They had previously issued a earnings per share and a GAAP number guidance, but they have received their information. And in this situation, it was specifically what was relevant to them is health insurance marketplace data, and it provided a lot of uncertainty, and they did not want to adjust the guidance. Instead, they withdrew the guidance entirely. There we have it. That was a quick dive into managerial guidance. I will have more Footnote Friday episodes that are coming to you. I hope that you enjoy them. Please like, subscribe, tell your colleagues and friends, and I'll see you in the next one.